Investing can be complicated and overwhelming. There are many different investment options, including stocks, bonds, real estate, and money market accounts. If you invest on your own, it's up to you to pick your investments, monitor their performance, and modify your investment strategy over time. Welcome to Wisdom Prodigy, where I discuss money, finance, and other intriguing topics to assist you in taking your financial game to the next level. So, if this is something you're interested in, give it a thumbs up for the YouTube algorithm. And if you're new here, welcome and subscribe. Let's get started now, shall we? What is a mutual fund? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder, therefore, participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund derived by the aggregating performance of the underlying investments. What are the benefits of a mutual fund? There are several reasons why an investor might choose to invest in a mutual fund. To name a few, mutual funds typically require a small initial minimum investment amount and are traded once per day at their closing net asset value, allowing them to be relatively accessible for most investors. Another advantage of mutual funds is that there is a team of professionals behind the scenes managing the mutual fund. For actively managed funds, fund managers follow market opportunities and other strategies to determine which stock, bond, and other securities to buy and sell, with the intention of achieving the investment objective of the mutual fund. Why do people buy mutual funds? Mutual funds are a popular choice among investors because they generally offer the following features. 1. Professional management. The fund managers do the research for you. They select the securities and monitor the performance. 2. Diversification, or don't put all your eggs in one basket. Mutual funds typically invest in a range of companies and industries. This helps to lower your risk if one company fails. 3. Affordability. Most mutual funds set a relatively low dollar amount for initial investment and subsequent purchases. 4. Liquidity. Mutual fund investors can easily redeem their shares at any time for the current net asset value plus any redemption fees. How do mutual funds work? A mutual fund is both an investment and an actual company. This dual nature may seem strange, but it is no different from how a share of APL is a representation of Apple Inc. When an investor buys Apple stock, he is buying partial ownership of the company and its assets. Similarly, a mutual fund investor is buying partial ownership of the mutual fund company and its assets. The difference is that Apple is in the business of making innovative devices and tablets, while a mutual fund company is in the business of making investments. Investors typically earn a return from a mutual fund in 3 ways. 1. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice either to receive a check for distributions or to reinvest the earnings and get more shares. 2. If the fund sells securities that have increased in price, the fund has a capital gain. Most funds also pass on these gains to investors in a distribution. 3. If fund holdings increase in price but are not sold by the fund manager, the fund shares increase in price. You can then sell your mutual fund shares for a profit in the market. If a mutual fund is construed as a virtual company, its CEO is the fund manager, sometimes called its investment advisor. The fund manager is hired by a board of directors and is legally obligated to work in the best interest of mutual fund shareholders. Most fund managers are also owners of the fund. There are very few other employees in a mutual fund company. The investment advisor or fund manager may employ some analysts to help pick investments or perform market research. A fund accountant is kept on staff to calculate the fund's NAV, the daily value of the portfolio that determines if share prices go up or down. Mutual funds need to have a compliance officer or 2, and probably an attorney, to keep up with government regulations. Most mutual funds are part of a much larger investment company. The biggest have hundreds of separate mutual funds. Some of these fund companies are names familiar to the general public, such as Fidelity Investments, the Vanguard Group, T. Rowe Price, and Oppenheimer. Finally, Mutual funds offer diversification, since most mutual funds tend to invest in several different securities. The risks associated with investing in a single security are reduced because you're not putting all your eggs in one basket. I hope you gained a few nuggets here. Again, like and subscribe. With that said, have a fantastic week, and I'll see you in the next one.